This is How to Invest by Julius Baer, taking on complex topics and breaking them down into bite-sized chunks so they're easier to swallow. But we've got our work cut out for us in this edition as we take on the complex but mighty bond market. As seasoned investors, you know that stocks represent ownership. When you buy a stock, you own a piece of a company. Bonds, however, are a totally different game. A bond is debt. Issuing bonds is one way for companies and governments to raise money. A bond functions basically as a loan between an investor and a corporation or government. The investor agrees to give the corporation a certain amount of money for a specific period of time. In exchange, the investor receives a periodic interest payment. When the bond reaches its maturity date, the company repays the investor. Sounds straightforward, right? Well, it is. But not all bonds are created equal. Some bonds, especially those backed by developed market governments, are considered much safer than those issued, say, by a newly established company. You can better understand how safe your investment is by its credit rating, which is essentially a report card for the investment outlining how likely an institution is to repay their debts. Have a look at this chart. The rating reaches from AAA, which indicates the lowest level of credit risk, to D, meaning the company is currently in default. Investment-grade bonds, which have the higher credit ratings, are considered to be relatively safe and offer lower returns. On the other hand, non-investment grade bonds, which have lower credit ratings, are considered to be riskier, but offer higher returns to compensate investors for taking on that risk. For example, if you invest in a bond issued by a company with a strong credit rating, such as AAA, you can expect a lower yield, which in the current environment is still around 4.5% in US dollars. If you invest in a bond issued by a company with a lower credit rating, such as a BB bond, you can expect a higher yield, around 6 or 7%, but you'll also be taking on more credit risk, which means there's a higher chance that the company might not be able to repay the principal value of the bond at maturity. The US undoubtedly dominates the global bond market. In fact, US government-issued treasury bonds are considered one of the safest investments in the world. The sheer size of the US economy also means its debt market is massive. It's also more liquid and more influential than any other. But before you're ready to start investing in bonds, there is one more chart you need to take a look at. This is the so-called yield curve. It's a graph that shows the relationship between bond yields along their different maturities. Normally, longer-term bonds pay higher interest rates because investors want to be compensated for tying their money for longer. A normal yield curve is a nice upward slope, but when short-term rates are higher than long-term rates, that's an inverted yield curve, and it can signal an upcoming recession, although not always. That's why everyone is obsessed with the yield curve. It's a bit like a weather forecast. When the yield curve flattens or inverts, storm clouds could be gathering, as it suggests investors are expecting slower future growth. So, how does all of this affect the price of bonds and the coupon you're actually paid? Well, bond prices represent how much it costs to buy the bond on the market. The bond yield is the return an investor earns based on that price. It's expressed as a percentage and changes when bond price fluctuates. So when bond prices go up, yields go down. And when bond prices go down, yields go up. But the coupon, that's how much in payment you receive, doesn't actually change for most bonds after issuance. Let me give you an example. So if a bond has a fixed $5 annual coupon interest payment and was originally issued at $100, that would be a 5% yield. But if prices rise to $110 for the same bond a year later, maybe because of interest rate changes or inflation or general economic conditions, the forward-looking yield drops, even though the US dollar amount the investor actually receives remains the same. Of course, the opposite happens when prices fall. What you decide to do as a bond investor when things change depends on many things. If yields drop, for example, you could sell at a gain and buy a new bond paying a forward-looking return, or hold until maturity if you're still happier with the lower yield. It really depends on your own circumstances, the investment goals, and expectations on how yields will develop further. Investors should always keep in mind that bonds are nominal contracts and they are not exposure to a company in real terms as with equities. But investing in bonds can be a great way to generate regular income and diversify a portfolio. There are some common mistakes that investors should avoid. Don't invest too much in a single bond or issuer. Spread investments across bond types, credit qualities, and maturities. Don't get sidetracked by high yields. Consider credit quality and risk when choosing your investments. What's more, higher risk can also come with less liquidity, a feature of the bond market which is all too often overlooked. Don't try to time the market. Predicting interest rate movements or market trends is difficult, and making investment decisions based on short-term market moves can be dangerous. Debt can get a bad rap, but as one of the biggest markets out there, it's not one investors can afford to ignore. Find out how you can add debt to your investments in our episode on building a balanced portfolio. It's already up on YouTube, where you can also like and subscribe to stay up to date with all our episodes.